This is the monthly chart on Carvana, and it's almost like circa 2020 with GameStop. Now, I had two different opportunities to get long Carvana. The first one, if we go to the weekly chart, was when we had a leg higher, two basic candles, and the strong move higher, which hit resistance at $20, only to come back and retest what was weekly bias level on top of a daily bias level at 550. Gave buyers not once but a second opportunity to take the stock higher. Okay, so I missed this at $6. Had another opportunity at 20 when price breached and closed above the resistance level at $20. If we scroll down to the daily chart, typically when you break out, you usually retest the origin of the breakout, and we had that opportunity on June 26th. So what's the phenomenon behind this crazy move higher? Well, it's all about the Reddit Wall Street Bets community against Wall Street. Let's get into the article. So this article is coming from Yahoo Finance. Carvana stock up 1,000% this year, leaving short sellers with a $2 billion loss. So Carvana short sellers have lost more than $2 billion this year, as the stock has rallied 1,000%. This past week on Wednesday, the stock gained 40% on the company announcing a debt exchange deal and released its second quarter results. We got to remember, the stock was at $4 back in late 2022. So according to S3 Partners, expect more shorts covering today and over the next few days as short sellers look for an exit point to trim their exposure in a very unprofitable trade. So if the shorts got to cover, that means they got to buy their shares, which is why we see price continuing to pump. Short sellers lost approximately a little over $500 million on Wednesday's rally. However, for the year, they're down $2.18 billion. Short interest in Carvana sits at 47%. That is crazy. Again, this was once a pandemic darling when shares just pumped and pumped and pumped. Even the downgrade a week or two ago by JP Morgan could not suppress price. However, let's listen to Jim. He does an excellent job at explaining this phenomenon.
Do it. Let me double down. Right now, I'm constantly asked about stocks that are flying, and they're not good stocks. Take Carvana, the used car play with a balance sheet from absolute hell.
The house of pain.
That in a just world, so to speak, would have gone under back when the stock was traded at $3 and change last December. There are people who do great work in this market. Their craft is to examine the balance sheet, realize the company will have a very hard time paying the interest on the debt, maybe presume that it can't make it, and certainly it'll only get more difficult if the Fed keeps raising rates, making it more expensive to get financing on a used car because they're based on the short rates. They smell a good short. And why the heck not after that, right? And Carvana's losing money hand over fist. Used car prices are going down, and they own a lot of used cars. Of course, these guys are disrupting the industry in a fantastic way. I loved buying a car from Carvana. I had it show up at my house. I didn't really like it. Send it back. Very different from the traditional experience, right? But those who know the craft, who can look at a balance sheet, read the Fed tea leaves, and notice the decline in used car prices, they know that this company's a goner. So they bet against the stock of Carvana. They shorted whatever they could get a hold of. Remember, you have to borrow the shares before you can sell them short. And they invested in Carvana going However, there's a whole other group of people who know nothing about the craft of stock picking as I just described, except that if you buy the stock and buy it and then buy it some more and then continue to buy it, and your friends do the same thing, then you can sometimes crush the short sellers simply by vacuuming up all the shares that the shorts need to borrow if they want to make their trade stick. A crushed short means a higher stock. And that's why being short is much more difficult than being long.
So for the week, price still closed higher despite the pullback after hitting $57. Price currently trades at $45.62. Question is the run-up over or just getting started? Why just getting started? Well, look at the monthly chart. Prices hit 360 back in July of 2021. This is a tough call. This is a tough call. All right, let's go down to the daily chart. All right. We got a couple of levels of interest. Got the first one right here. That is daily sellers, which hit once. It's pulling back a second time. Typically, when price continues to hit a level multiple times, eventually gets weak until it gets broken. All right. So I think this level is going to be taken out at some point. But then you got a level on top of a level. So typically levels on levels are really strong. When the first one gets weak, it has the second one to lean on. If you have a long game view on Carvana, you can look at this level to potentially hold. Again, all the moving averages are pointing up, turning and pointing up, including the 200-day moving average. These moving averages serve as support. So you have price in the middle between daily sellers level and a daily buyers level. You have momentum up. You have the trend up, at least short term. If you want to put odds in your favor, you go with the trend. Yes, there are many counter trend traders that make money, but a lot do not. Easiest way to trade is the trend is your friend. So look at this level to potentially hold. Now getting through 56 and 68 is going to be tough. But again, 2 years ago it was at $360. This is the gap up on earnings. We had another gap up on earnings in May. Had a gap down in February. The fact that they restructured their debt, the fact that used car prices are coming down, the fact that demand is picking up because used car prices are coming down, the fact that interest rates are probably going to settle out now, gives Carvana the opportunity to become profitable again, or profitable first time moving forward. I love their business model. I think it's here to stay. I think Carvana is a speculative play, but 10% of your portfolio should go to speculative plays. If that is the case, buy on pullbacks. Look for $36 to hold. Look for the grind higher to be slow, as at least I missed this move higher. Thanks for watching. Subscribe. Please like the video.